lot happened last week. The risk premium in the market is being adjusted. No question about it that valuations are being adjusted. Yes, I do think that this is a market correction still in a bull market. At this moment, we don't have a recession, and therefore we don't have a bear market. And the reason we don't have a recession is because the economic data that we see doesn't indicate that. We still have GDP growth rates north of 4%, and when that growth rate will be adjusted to tax breaks coming off, still will be most likely at 3.5%. So that doesn't change. We still have very strong employment numbers. Unemployment is still at 3.7%. We still have very strong leading indicators, of which the first one, Institute of Supply Management, is just about as high as 62, which is the second highest leading indicator in history. Yeah. The last one, a bit higher than that, was back in 1998, so that doesn't change. We still have no inflation really to talk about. Inflation is at 2.1%, and the Federal Reserves, although they are raising rates, they are doing it still very gradually. So that doesn't change the macroeconomics and the fact that we are still, in my view, in a bull market. However, there are things that are changing as we speak in the marketplace. And I'm going to pick again on the FANG group, which is Facebook, Amazon, Apple, Netflix, and Google. Now, these companies in the past 4 or 5 years went up cumulatively about 38% annually, as opposed to the market, which was going up about 8% annually. And last week, we started finding out different things. For example, the Chinese apparently installed spy chips in some of the American servers of companies like Amazon and Apple. On the surface, you don't think much of it, but the reality is these companies will have to account for better security on their servers. So how do they do that? They can either relocate their manufacturing from China to other parts of the world, change their supply chain, or they can have better quality control to make sure that there are no spy chips anymore in their servers. Either way, we need to account for that cost adjustment. So the FANG stock should be discounted about $400 billion just on the spy chip alone situation that came about last week. We need to think about these things, and this is why I say, although it is a correction in a bull market, in my view at this point, nevertheless, we might see some valuation compressions. We need to see more volatility as a result of that, and we need to take into account that especially the technology names that carry the market possibly will be adjusted downward in valuations. Not only that, the moment you see interest rates going up, a lot of these analysts on the street value these companies on cash flow basis. Interest rates go up means the economy is doing better up to a point. When interest rates cross that threshold of 5%, then we start having negative correlation between interest rates going up and the rest of the market. That benchmark of 5% might have to be readjusted because the growth rate of the economy is about 3.5%. So the benchmark should be, I think, in my view, downgraded to 3.5%. Now, if interest rates going up can cause increase in discounted valuations for the technology names, it means to us, for example, we need to look at companies in the technology sector that are not selling at 50 times earnings. We need to look at companies in the technology sector that sell at very depressed valuations, such as IBM, selling at 10 times earnings, paying 4.5% in dividends, buying back their own shares. Another company might be Cisco, selling at 15 times earnings, pristine balance sheet, paying about 3% plus dividends. But we need to be very mindful at what prices are we willing to jump in and buy companies. Now, Facebook recently, last week, after the recent market sell-off, now sells at 17 times earnings next year and still growing at 17%, which is not bad. Apple sells now at 16 times earnings. Growth rates next year are expected to be 16%. Google sells now at about 21 times earnings. Next year, growth rate is expected to be at about 10%. Also, I saw something very interesting over the weekend. In the past 65 years, we had about 15 times when interest rates were rising. And guess what? In the face of interest rate rising in the past 65 years, during these 15 times, only 3 times the market went down a few percentage points. But in most cases, during these 15 times increase in rates, markets actually averaged in the following 12 months 12.6% returns. And that supports our view that a rise in interest rates doesn't necessarily indicate anything bad. In fact, it indicates that the economy is moving along in a positive way. The biggest fear right now in the market is a mistake by the Federal Reserves. They will raise rates another 25 basis points in December, most likely, and then they are expected to raise rates 3 more times next year.